Hello, my name is Sonu Park. I will present about what can we read from economic article and make some conclusion from the article. The subject of article is highlight IMF World Bank 2014 for meetings in Washington on Saturday. Following parts of articles lead to some knowledge about some economics. So I will explain some economic concepts about the parts of articles. First part, there is current account. If we do not know this, we cannot understand this part. What is the current account? It is one of the two components of country's balance of payments and capital account. It consists of the balance of trade, net factor income and net cash transfers. Current account index show that competitive power of the nation in trade market. So in this chart, the strong exporting countries like Germany and Japan show high level in this article. Ukraine's current account had damage from the war with Russia. It means Ukraine's global competition is becoming very weak, so they want the help from not only IMF but also other organizations. With some external help, Ukraine wants to recover their current account. Next, in the part of articles, the governor of Central Bank of Ukraine had a meeting with the EBRD. What is EBRD? Why did Ukraine meet them? Because the EBRD is European Bank for Reconstruction and Development. They provide project financing for banks, industries, and businesses, both new ventures and investments in existing companies. In former part, Ukraine found some organization to receive help. In this part, they found the solution. EBRD helped their countries in the region to become open market economies. So we can understand that there is some organizations for poor nations and they supported some countries for recovering confidence to all market. And now EBRD is considering the unique special program for Ukraine. Next part, we rarely understand this sentence without the concept of tightening. Tightening means tight monetary policy. It implies the central bank or authority in charge of monetary policy is seeking to reduce the demand for money and limit the pace of economic expansion. It will typically be chosen when inflation is above the inflation target or policymakers fear inflation is likely to rise without the tightening of monetary policy. It could be done by two types. First is raising interest. Higher interest rates tend to reduce aggregate demand because borrowing becomes more expensive. Therefore, firms and consumers are discouraged from investing and spending, so saving becomes more attractive. Therefore, firms and consumers are more likely keep saving money in the bank rather than spend. Second type is open market operation. It is done by printing less money or sell long-dated government bonds to the banking sector. But in tight monetary policy, if there is cost push inflation, it may lead to lower economic growth, and if the confidence is very high, people may continue to borrow and spend despite higher interest rates. And next part, the concept of currency intervention is very important. It is also known as currency manipulation. It is the purchase or the sale of the currency on the exchange market by the fiscal authority for the monetary authority in order to influence the value of the domestic currency. There is conflict with currency intervention. One side has the opinion of aggressive manipulation for exchange rate. They said governments should intervene in the currency market and control it directly. The other side insists in direct currency intervention. Their opinion is governments should step away from the exchange rate in these articles. Russia is the second position. So Russia can have this advantage from survival in global currency war. They may not keep their money value, but it does not bring side effect from direct intervention. Next, Russia has very big worry about capital flight. Capital flight means that in economics, it occurs when asset or money rapidly flow out of a country due to an event economic consequence. This leads to a disappearance of wealth and is usually accompanied by a sharp drop in the exchange rate of the affected country. This leads to dramatic decrease in the purchasing power of the country's assets and makes it increasingly expensive to import goods. So, through these concepts, we can know Russia's value of the money is not stable and they can have exchange rate problems. I think it is caused by the passive currency intervention. Russia government should do active strategy for their own economics. Another economic problem is shown in the next part of articles. It is the uneven recovery. In IMFC community, it is dealt with very importantly. Normally, deep recessions. It is dealt with very importantly. Normally, deep recessions are followed by more rapid recoveries, but the world shows the rich countries take the recovery gap and poor nations could recover. Look at this chart. In the US, after global finance crisis, versus 7% take more and more advantage than lower 93%. It is very big problem. So in IMFC communities, our first problem to resolve is the uneven recovery. It should be done for the tomorrow's potential growth. Finally, in this part, there is the concept of financial bubble. A financial bubble is trade in high volumes at prices that are considerably at variance with intrinsic values. It could also be described as a situation in which asset prices appear to be based on implausible or inconsistent views about the future. There was an example why the fiscal bubbles is seriously worrying. There was global crisis in 2008. It started with boom of subprime mortgage loan. It taught us that once bubbles collapse, we hardly stop it. After knowing this, we can easily understand why the Dutchman in the article seriously worry about the financial bubbles, and he thinks the next crisis starts from the euro area because the signs of excessive financial risk-taking are already emerging. With some concepts of economics and this article, we could know about the overall global market a little. Through the current account and EBRD, we know that global economics interact each other, and with the concept of tightening and currency intervene, we could know how governments deal with the economic problems and survive globally. And finally, we found some problematic global issues like capital flight, uneven recovery, financial bubbles. Thinking solution for these issues, our economic knowledge should be wider. Thanks for watching my presentation.